Hello, in this problem, as we prepare for the first exam, we're given an income statement and we're asked to look at the information given and then adjust that income statement accordingly. So it says you first look at the trial balance, and in addition to the accounts on the income statement, which I've put into T accounts below, you find the following. So I've added supplies, which is a current asset, prepaid insurance, current asset, and a note payable. And making inquiries, you discovered the following. 1. Travel services revenue of $50,000 included advance payments for cruises of $30,000. The cruises will not be taken until May and June. And notice that the information we're looking at right now and the income statement we're preparing right now is for March. So do we have too much revenue recognized in March that will not be earned until May and June? So we need to reduce the travel services revenue by $30,000. Because that $30,000, although we've gotten the cash for it, really belongs in a liability account called unearned revenue. So removing that revenue from travel service revenue, notice that our revenue account now is reduced to $20,000. So travel service revenue, $50,000. Minus $30,000, the correct amount is $20,000. So we're fixing them. Number 2, there were $800 of supplies on hand as of March 31st. Well, if all we had is $800, the difference between the supplies balance and the supplies on hand must be the supplies we've used. And those supplies belong in supplies expense, which right now is not on the income statement at all. So to move the supplies used or consumed, the difference between $3,200 and $800, which is $2,400, into supplies, we'll debit supplies expense and credit supplies. And now the correct number is in the supplies account. And to our income statement, we're going to add an expense account called supplies for $2,400, the amount of supplies that have been used or consumed, supplies expense. Number 3, prepaid insurance resulted from the payment of a 1-year policy on February 1st. Well, it's a 1-year policy, so that's 12 months. So that $1,200 benefits 12 months, or it's $100 a month. Now, if we bought it on February 1st, that means we've used the insurance for February and for March, which is just 2 months. So $100 times 2 months is $200, is all that has been used or consumed. So I need to get $200 out of prepaid insurance and into insurance expense because we've used it or consumed it for $200. That means that I'm going to add an insurance expense account for $200 because it's been used or consumed. Notice my lines are off here, so I better make sure that I don't mess anything up. Okay. So that takes care of number 3. Number 4, the mail on April 1st brought a utility bill for the month of March, which means we've used it or consumed it, but it has not yet been recorded. So we have right now an account called Utilities Expense for $400, and it really needs to be increased by $180. So we would debit utility expense we'd credit accounts payable 180 because we need to pay that bill. So notice utilities expense really should be $580, not $400. So utilities are $580. Number 5. There are 2 employees who receive a salary of $75 each day. As of March 31st, 3 days of salaries have been incurred but not yet paid or accrued. And that's where we debit salaries expense and credit salaries payable, isn't it? So I need a salaries payable. Now we have 2 employees who each make $75 a day or $150 a day for the 2 of them, and we've incurred 3 days, Monday, Tuesday, and Wednesday. So 150 times 3 means that we have salaries expense that we want to include of $450. So I would debit salaries expense $450 and credit salaries payable $450 to accrue that amount. So the salaries expense on the income statement should be really $64.50. So salaries are $6,450 to accrue through year end through all the employees' usage that you've had. So that was number 5. Number 6 says that this $10,000 note payable is a 6-month note that was dated January 1st, and the interest rate on that note is 10%. Well, we know that if we have a note payable, we'll also be accruing interest on that note. And you'll recall that interest expense is the principal times the rate times the time. So in other words, the $10,000 note at an interest rate of 10% a year, and the time is January, February, and March, 3 months over 12. So 3 months of interest needs to be accrued. So to accrue that interest, if I do my math correctly, that's $250. So I need to accrue $250 of interest. So I'm going to debit interest expense, $250, since that account does not exist, and I would be crediting interest payable, $250. So adjusting my books, I don't have interest here, so I'm going to include interest expense, which is usually another other revenue and expense type items of $250. So I think I've run out of information, so let's see how we're doing here. We now have adjusted our revenue to $20,000. We have salaries of $6,450. Advertising remained unchanged. Rent expense remained unchanged. Utilities expense increased because we received that bill. Depreciation remained unchanged, and we added supplies expense of $2,400, insurance expense of $200, and interest expense of $250. So if we readjust our net income, our expenses don't come to that either. So our expenses, operating expenses, comes to $14,130. So that's before the interest expense. So our income operating income would be 20,000 minus 14,130, or 5870, minus our other expenses of 250. So 5870 minus 250 gives us a revised net income of 5620. Now, if you didn't pull interest expense out as other expenses, it's something to aspire to, because interest is different from day-to-day operations. You don't go into business to borrow money, so it's always classified as an other. Just like interest income would be other revenue, interest expense is other expenses. So to revise this problem, our correct net income, corrected, is 5620.